Landlords are pulling out of the real estate market, and not for the reasons you might think. Many who bought properties in the last 5 to 10 years are starting to realize that owning real estate isn't always the easy money it's made out to be. As housing inventory rises across the country, more investors are looking to offload their properties. If you're thinking about buying an investment property, this is the perfect time to pay attention. Stick around to the end because we'll cover one critical mistake that can sink any investor no matter what kind of asset you're buying. Rents just aren't rising like they used to, and in some cities, they're actually going down. During the pandemic, investors poured into hot markets buying properties thinking rents would keep climbing crazy high every year. But that growth has pretty much stopped, resembling the trend of inflation. Across the country, rent increases have slowed way down, with many places seeing little to no growth and some actually experiencing drops. The ones that were the hottest during the early 2020s are unsurprisingly seeing the most softening. This is hitting landlords hard who bought recently at high prices. They were counting on rent going up enough to cover their mortgage and other costs, often running on very tight margins, speculating on future growth and continued property appreciation. For example, they might have purchased a place with monthly carrying costs around $5,000 and expected rental income about the same. They figured rental demand would remain strong and continue to skyrocket. But now, with rents flat or dropping, while taxes, insurance, and maintenance costs keep rising, the income isn't enough. A lot of these investors are underwater, holding properties that cost more to keep than they bring in rent. For many, selling is the only way out. It's even tougher for short-term rental owners who thought they'd cash in big by listing on Airbnb and similar platforms. Many expected to pull in $50,000 a year or more, but with travel patterns changing, more competition, and stricter rules in some cities, their income has often dropped to half that, or less. Meanwhile, their bills, mortgage, taxes, insurance, and maintenance haven't gotten any cheaper. With rent cut in half, but costs staying the same or going up, many of these owners are feeling the squeeze and looking to sell. After years of rapid price increases, home values in many cities have begun to level out or even decline slightly, closely tied to how overheated these markets were over the past 5 years. For landlords who bought at or near the peak, this is a tough pill to swallow, especially if they were hoping to make large year-over-year returns. If they bought a home for $700,000, they expected it to rise to $770,000 within a year and hit $850,000 the following year. But when they realized it's still only worth $700,000, or in some cases even $650,000 after a couple of years, they weren't pleased. Instead of holding tight and riding out the normal ups and downs of real estate like you would the stock market, they rushed to sell before things got worse, as if they're outsmarting the market. This kind of short-sightedness can turn what might have been a solid long-term investment that just needs time to stabilize into a forced sale at a loss or minimal gain. Another reason they're jumping ship is simple. It's way more work than they expected. On social media, owning rental property often looks passive and easy. Collect rent checks, watch your equity grow, and kick back. But the reality? It's more like having a part-time job. Any honest property owner will tell you this. It's not fun hearing from your stressed-out tenants on Thanksgiving when the water heater breaks, the HVAC dies, or the fridge stops working. Now you're scrambling to find someone to repair it as soon as possible. Or maybe your tenant stops paying rent and suddenly you're spending your nights learning the state's eviction laws, filing court paperwork, and showing up to hearings. So much for passive income. Even basic maintenance catches a lot of people off guard. You might think changing an air filter is no big deal until you forgot about it for a year and now your HVAC system fails. That's a multi-$1,000 repair because something so simple got neglected. And guess who's paying for it? You are. That's not to mention flushing the water heater, making sure the landscaping's kept up, cleaning out the gutters, dealing with pest control, replacing smoke detector batteries, checking for leaks after heavy rain, or patching drywall after a tenant's dog got a little too excited. Then there's tenant turnover. It's not just a matter of finding someone new, it often means repainting walls, replacing carpet, deep cleaning, and listing the unit. Then becoming an expert on tenant placement, debt-to-income ratios, income verification, and fair housing laws. You might even have a month or two of vacancy where the property is just bleeding money. If you're doing all these things yourself, that's your evenings and weekends gone. If you're using a property manager, there goes 10% of your rental income. And who's going to do all this repair work? If you're not going to do it yourself, at least be prepared to vet painters, cleaners, get prices on new flooring, and make sure the job gets done to your satisfaction. None of it's glamorous, and it all takes time, money, or both. All of this work is even more intense when it comes to short-term rentals. With long-term tenants, you might deal with a repair here and there, but with short-term stays, the turnover is constant, and so are the surprises. Your guest who checked out this morning broke the couch, and now you've got 2 hours to scramble for a replacement before the next guest arrives. Or they didn't bother to tell you that the faucet won't stop burning. Maybe you find a last-minute solution, but now you're out hundreds of dollars and scrambling with logistics. Or maybe the cleaners called to say that the last guest left the place trashed, dishes piled up, linen stained, and food spilled all over the place. Now you're either rushing over yourself or paying double for emergency cleaning just to make it nice for the next guest and avoid bad reviews. And once they get there, the messages flood in. How do you turn the bedroom light on? We can't figure out the TV remote. Do you have to point it at the TV? The washing machine is broken. It just keeps filling with water and spinning. What was supposed to be passive income quickly turns into a high-stress hustle. Many landlords, especially new ones, underestimate how much routine and unexpected maintenance can actually cost, and how quickly those costs can eat away at what looked like a decent cash-flowing investment on paper. It's one thing to factor in basic repairs, but the reality is that maintenance is rarely that predictable. Take something as simple as a water leak. Let's say a tenant reports a small leak under the kitchen sink. You call in a plumber who charges $150 just to show up. The repair ends up costing another $300. Not too bad. But then you find out the leak went unnoticed for longer than expected, and now there's water damage to the cabinet base and there's mold starting to form underneath. Suddenly, you're hiring a contractor to replace the cabinetry, a mold remediation company, and possibly even repainting part of the kitchen. Now that small leak turned into a $5,000 headache, and that might have been your entire cash flow for a couple of years. Then there's the HVAC system. Whether it's an unexpected breakdown or just time for a routine replacement, they don't last forever. You could be looking at a bill anywhere from $5,000 to $20,000, depending on the size of the property and where it's located. If your monthly cash flow is $300, that single expense could wipe out years of profit in one shot. Then there's the roof. In many parts of the country, an asphalt shingle roof might last 15 to 30 years, but when it's time to replace it, you're likely facing a cost between $5,000 and $15,000 for a typical single-family home. If you're not an expert in estimating repair costs and setting aside enough of your monthly cash flow for major fixes, and many investors aren't, your profits can vanish or go negative instantly. At that point, you're not just breaking even, you're potentially losing money and wondering why you're doing all this work just to keep the property afloat. New landlords often fall victim to shiny object syndrome. They're drawn in by stories of quick flips and skyrocketing rents, thinking real estate is an easy way to make fast money. At first, the idea of passive income and fast appreciation feels like a golden ticket, especially with low interest rates, but the reality sets in sooner or later. Constant maintenance, problem tenants, vacancies, and non-stop management headaches. Those challenges make the shiny dream lose its appeal. Now, many of those same landlords who rushed in are rushing out, spooked by slowing rent growth and softening prices. Instead of holding on, they're cutting losses and chasing the next easy opportunity, turning the buying frenzy into a selling scramble that floods the market. Unfortunately, the impatience of many novice investors is what will likely be the downfall of their real estate journey. When they first jumped in, they were riding a wave of excitement. Double-digit price increases, rapid rent growth, and headlines about quick, easy profits. But now, with those explosive gains behind us, their enthusiasm has faded, and so has their tolerance for the slower pace of a stabilizing market. Here's the thing. A stabilizing market isn't a bad thing at all. It's actually great for landlords. Instead of the wild ups and downs that make it hard to plan ahead, partly due to crazed so-called investors driving wild market trends, a steady market offers predictable cash flow, fewer surprises, and less risk of sudden price drops that can wipe out equity overnight. When the market frenzy cools off, prices and rents settle into a more balanced rhythm, growing at a slower but sustainable pace. And that's exactly what real estate investors should want. Steady, reliable growth over the long term. Real wealth in real estate usually isn't made by chasing the next big spike or flipping during a boom. It's built by holding through the slow seasons, reinvesting in your assets, and benefiting from consistent appreciation and rental income year after year. The market's slow and steady phase might feel boring or frustrating, especially those used to fast wins, but it's the foundation for building real, lasting wealth. Those who recognize this and stick around, who focus on managing their properties well and riding out the natural cycles, are the ones who usually come out ahead. Here's the key takeaway. Real estate isn't collapsing. It's just settling into a steadier, healthier pace. Success comes from patience and long-term thinking, not chasing quick wins or panicking over every market change. So if you're considering investing, tune out the noise and focus on smart choices and steady growth.